properly live, and lots of people listen to it.
Yeah.
I found it quite daunting.
Did you tell your mum?
I did. They all logged into the wrong radio station.
So there we go.
Yeah, so no one heard
I never tell anyone I know.
Do you not?
Until I know it's gone well, and then they can watch it on replay.
Yeah, it was. I did find it. I guess I just haven't done much of it, but I did find it quite. I found the whole LBC News ringing you on your phone or iPad is quite stressful.
Yeah. No.
And then you can kind of hear them talking live in the background, and I didn't particularly like that. But,
Okay.
That's what it was. John's a pro, apparently.
It's not John learning. Get L plates. Should we make a start? Vicky's got to be gone. So we better get moving. Hello, everyone, and welcome to Taking Stock After the Bell, episode 64. Joined as always by James Hughes, who's traipsed in on a Friday to the City of London. For the main event, really, we are delighted to be joined by Vicky Reynal. Vicky, good afternoon and welcome. Vicky is a leading financial psychotherapist and author of Money on Your Mind, The Psychology Behind Your Financial Habits, which won both the Best Personal Finance and Money Inclusion Awards. Vicky also writes a column for The Times and The Sunday Times on the psychology of money. She's based in London, works with a global client base ranging from ultra-high net worth individuals to those navigating financial anxiety, helping them to understand the emotional drivers behind money behaviours. Vicky holds a psychology degree from an Ivy League university, an MBA from a London Business School, and a postgraduate qualification in psychodynamic psychotherapy.
You've been practicing that, haven't you?
Got that
It's a tongue twister.
Isn't it? Welcome, Vicky, and a very impressive CV indeed. How do you find yourself in the position of being a financial psychotherapist, and what's your journey been like?
Well, it feels like a natural fit because of the journey I've been on. And it's been a great way to marry my different interests into something that can actually help people and something that maybe wasn't quite present before. And so it targets what I find is a need in people, which is to understand the emotions and sometimes the unconscious thoughts and feelings that can be driving their relationship with money. Because I find a lot of people struggle with finances and want to act differently when it comes to money, but get stuck. They don't know quite how to move on, despite knowing what they should be doing. So they might have seen very capable advisors and financial coaches, and they know what they want to do differently, but they can't quite get themselves to do it. And that's when feelings are getting in the way. I
think what I was most interested about today in particular is obviously James and I sit with a lot of wealthy individuals, and we talk about their money, and obviously we advise them, we manage their portfolios, and we get and there is some, you do come across some behaviours which sometimes leave me a little bit startled and do require some managing. I mean, why does money trigger such strong emotions, and where does all that sort of come from, if you like?
Well, what I found really interesting is to see how, yes, there are the money lessons that many of us weren't taught growing up, and the low level of financial literacy can be a problem. But actually, when you see those shocking and problematic behaviors around money, what I find, there's experiences in the past, some that are not even related to money, that could be at the roots of those problems. Right. So to give you an example, somebody that doesn't grow up with a good sense of deservedness and feeling worthy, then they might find it really difficult to either enjoy their money, enjoy the good things that money can buy. And so they almost hoard it in shame. Or they might find it difficult to hold on to it and unconsciously self-sabotage their success. So they might make a bad investment without even thinking about it, no due diligence. And they kind of find that they end up losing money here and there, not understanding exactly why. And when you start to unpack it, there's some guilt about having, or a sense of not deserving it.
And is that childhood related issues in the main upbringing?
Well, that's right, because our sense of feeling worthy and deserving is established early in childhood, in a relationship with our parents, with our caregivers. So from infancy, we build a sense of who we are and whether we're lovable and worthy of things by the first interactions with our parents. So whether our mother smiles back at us, tells us, okay, there's somebody smiling at me, that means I'm good. If we then grow up and are repeatedly told off, criticized, punished, anytime we try to do something and make a mistake, we have an experience of that being shameful and bad, then we internalize a different message about ourselves, that, we're not allowed to make mistakes, our bad parts, if you will, are completely unacceptable. So we grow up having a pressure to always be good, always behave. We might be very risk averse because taking any risk is fraught with fear. Yeah. We might people please, so we spend a lot of our money buying things for other people. We think, that's the price we need to pay to be loved. We have to give things away, be the good person other people want us to be. So you can see how those early interactions really shape the messages about us and how relationships work, how much we're expected to give versus receive, how much are we allowed to have without feeling guilty. All of that starts very early on.
Okay.
And does that differ from kind of region to region or country to country? Because I think my observation is in the US, kind of money and success is celebrated. And, obviously I don't live in the US, but whenever I visited, which is fairly regularly because we have on my wife's side, we have some family that live there. But I find people in the US tend to talk about money and investments far more freely, whereas in the UK, it's hidden and even, even discussed between friends or even recommendations. I rarely see it.
Yes.
But why would that be?
So there's different layers to how we built our relationship with money. Childhood, our deep-seated longings, fears, desires is one level. Then there's experiences we have later in life. There's our personality. Are we impulsive? Do we make choices without thinking? We might be like that with everything in life, with food, with money, with other things. So personality comes in. And then there's culture. And you see people who are raised in cultures, as you're pointing out, that are very open about money, unashamed about its pursuit, that are built around creating success and creating wealth. And so they embrace that. And there you might find less shame around the pursuit of wealth. But when I say culture, it's quite broad. I also mean religion, politics. So there's people raised in certain religious context in which what is praised is being modest, not overreaching, being very generous. And so there's a certain guilt or even a moral corruption associated with having a lot of wealth and pursuing it openly. And of course, there's political views around this as well. So if those messages were really reinforced in your family growing up, then becoming, capitalistic and unashamed in your pursuit of wealth can be, it can create an internal conflict in you because a part of you might want that. And as an adult, that's what you want. But as there's that child part of you that picked up all those messages. And so those two parts of you are wrestling and it can cause guilt and shame.
Interesting. James and I, and perhaps a lot of advisors and others, will sit and meet with a lot of high net worth individuals, wealthy people in general. And a lot of those wealthy people will be from very different backgrounds, whether that's people who are third, fourth generation inherited, sort of old fashioned, what you might have described as aristocracy. I'm not sure we're allowed to use that word anymore, are we? But old money effectively, but also, boy done good, built a business from nothing, came from a 2-bed council house and wherever and sold a business for millions and has now got a load of cash. And what are the sort of behaviors that you see from wealthy people? And do those sort of two kind of polar examples or polar opposite examples, extremes, are their behaviors towards money different? And that's not necessarily just a childhood. Well, perhaps it is just a childhood thing, but what do you sort of see in terms of the psychology of those sorts of examples of people that are used?
I think that there are some general traits, but I will premise that by saying that often it's not the experience per se that we had, whether we grew up in money or in scarcity, but it's what we made of it. So I have seen people who grew up very poor, and then they grow up and they achieve a lot of wealth. And some of them, what they do is they hold on to it because they want to make sure that they never feel that longing. They never feel that sense of not being able to have what they wanted ever again. But I've also seen people who realize the power, the freedom that comes with having money and begin to spend it recklessly, because now finally they can have all those things that they've always wanted. And so you can see two very different outcomes from the same background. But generally speaking, I'd say that, people who come from money don't tend to carry the same anxieties around it than people who are first generation wealth, who have had experiences of maybe seeing a parent going bankrupt or, parents working tirelessly to try and accumulate wealth. And so when they finally have it, it feels more fragile, more...
That's a bit of house of cards almost.
Yes, that's right. And so there are more anxieties around it. There might be more guilt and maybe even shame. And maybe I'll distinguish the two in a minute. But there's difficult feelings around having done better than your family, having done better than your friends.
Friends and peer group.
Yes, being able to afford the things that they might still be unable to afford. That can be quite difficult. So there are sometimes fears of isolation, of judgment that come with that. And then there's the fear of spoiling the next generation, because you're raising children in a very different context from the one that you were raised in.
Yeah, we'll definitely come to that, given that we both got young children.
It's very and very live with kind of client meetings and very live discussions in terms of planning for inheritance tax. What is too much? What is enough, and sort of how to plan to gift, but also. The big question is, I'd like to gift, but I want control of the gift, which, because that young person might be reckless with it. And I don't quite trust them yet. So I know it makes sense to gift that, large, little, whatever it is. But, can I tell them what to do with it? And of course, that is very difficult to do. There are trust structures and things like that. But in reality...
can't have the cake and eat it.
Correct. And I think that's what successful clients find hardest. And I think if I think of the type of client, that's probably more first generation wealth, where it's, John's example of boy, girl, done good is I've had to work exceptionally hard to get where I've got to. And it's how do I teach the right lessons to, that child beneficiary, etc. So,
Well, it's good to start early with that, because I think what happens is that parents might not know quite how to pass on the values that they had in a very different context that their children are living in. And then when it comes to passing on the wealth, they're passing it on to somebody who hasn't been prepared with the same mindset. Sure. So if you prepare them from before, then you don't need to be controlling in your generosity, because you can trust that they'll act in a similar way to you, because they think in a similar way.
And just coming back to that point about someone who's done well from a relatively modest upbringing, and those feelings of guilt and anxiety that carries with that. I mean, if you were James or I and you were sat in front of that person who's just had a 7-figure sum dumped into his bank account, his or her bank account, how should we be communicating with them? How should we be, discussing it? It's going to be a very different conversation to someone who's naturally from a wealthy background or is a law firm and sort of a lawyer and has built his wealth up over 30, 40 years. What should James and I be sort of looking for, or how should we be communicating with that person?
So I guess you're asking in terms of conversations around passing on the wealth.
No, well, in terms of the first principles. Right, you've now got a load of money you didn't have before. How can we help you?
Yes.
How do we help you with those feelings that you've got and those that difficult next step, because it is a difficult next step. I don't know, you probably know the statistics about the percentage of lottery winners that either end up bankrupt or suicide rates among lottery winners really high. Do you just want to touch on that and how advisors can help their sort of clients with those sorts of feelings?
Well, I'd be curious about their experience of it. So that's where I would start. So don't make assumptions about how they're feeling about it, because some people might feel very proud and liberated that they've made all this money and they can't wait to invest it or enjoy it. But others might be, you might be seeing this as you go through their finances. They might be holding on to it a bit too tightly. You know, why aren't they investing more for the long term? What's going on there? And that's when you can bring your curiosity and say, you know, what's that about? Well, you know, and when I grew up, they always said, you know, investing is reckless. Okay, well, let's think about that. And how can we minimize the feeling that it's reckless by keeping some things safe and, you know, taking more risk with others and so on and so forth. So I think it's really about being curious and unpicking what the experience is for each person, because you might, and I think this applies to all kinds of clients that will walk in the room. They might come in with very broad statements like, oh, you know, I'm afraid about the future. Well, afraid of what? You know, what does that mean? Well, I'm not good with money. Well, you know, let's look into that. And that could mean all sorts of things. For one person, it could mean that they're afraid of their impulsivity. They're afraid that once they open that lid, that spending will go out of control and they won't be able to hold themselves back. For other people, it could be about all the catastrophic scenarios that they build in their minds about the future. And sometimes it is based on kind of scripts they picked up in the past. You know, debt is bad. I'm sure you've heard that one. Or, there's some debt that's bad, but sometimes leveraging is not a bad thing. So you can help them maybe challenge a bit some of those old beliefs. But before you can do that, you need to help them open up about it. And the way to do that is to ask some open questions, not leading, making assumptions, but things like, well, you know, what keeps you up at night about money? What do you wish you could do? You could be doing differently?
I always find myself in those sort of situations, particularly with a client who's never invested before and inexperienced. I tend to go down the kind of blind them with data and science. That's perhaps being a bit harsh on myself, but you've never invested before. Investing's brilliant. Look, here's a chart of the stock market for 100 years. Bottom left, top right. What does that mean? Goes up. Right. Occasionally, see those little squiggly bits, goes down a lot. We need to watch those. We need to manage those. However, this is in your and I sort of think, well, actually, is that always the right thing to do? You've got to bring people with them. You've got to meet them where they are, right? And you've got to try and tease out where they're coming from in terms of their views and opinions before you can seek to.
Yes. And where they're going. So not just where they're coming from. And I think that's the bit that can be very emotional as well. And maybe it's important that it is, because people don't really get moved by numbers. They get moved by a story, by a future vision of themselves. So are they working towards, you know, retiring peacefully and being able to enjoy those holidays they haven't been on? Or is it about legacy and leaving something behind for the next generation because their father wasn't able to do that? Or, you know, whatever it is, invite them to articulate that dream from an emotional side, because that's something that you can go back to in times of volatility. And I know that a lot of advisors struggle when markets are like they have been recently, because everybody gets scared. It's normal. But what isn't good is to abandon plans as a result of that fear. And in that moment, you can use those stories about, well, you know, this plan is going to get you there. And why don't we stick to it? Because that's important to you. And maybe it's not worth abandoning just because you're seeing movement that might be frightening, but let me take you through it.
I think you raise a good point that in my opinion, a large part of the value that we often add to client relationships is in those periods when the proverbial is hitting the fan and markets are. And we've had 6 years. I mean, I didn't have any grey hair 6 years ago, but we've had the pandemic, 35% decline, 2022, 25% decline, nasty, that was elongated. we've just had the tariffs a year ago, and we've got a war in Iran going on at the moment, when we've had a 10% equity market. Like we've been through quite a lot. So I sort of feel like I've had quite a lot of those conversations with clients. Again, I wouldn't say my default, again, this is perhaps being a bit harsh on myself. My default is equity markets go down 10% all the time. They go down 20% at the time occasionally. And sometimes, well, generationally, they go down 30 or 40%. It's part of the nature of the beast. And I think perhaps your point there about, instead of just blinding them with the data and the science and the numbers, and it can be better to say, well, this is part and parcel of what we've talked about, and this is still going to help you on your journey to fulfill your objectives and your hopes and dreams and aspirations. And I think that's probably a better way of framing it than perhaps just stick a chart up and go, well, this happens all the time. Don't worry about it.
Yes. It's so important to reframe it as a normal part of investing, rather than, and it's natural for people to respond to it as, this is a signal, it's a danger signal, I need to respond to this, I need to take action. And that's what we do physiologically when we feel fear. It invites us to take action.
That's an evolutionary thing, right? That goes back to...
Yes, it's loss aversion, and it's built in us for, as you say, evolutionary reasons, because it was better to overestimate threats. And so we learn to activate ourselves in the face of a threat.
So is that just flight or fight, essentially?
Exactly. So our amygdala fires, and that means that we are unable to think, and we go into action mode.
Okay.
And the way to override that sometimes is to build in a bit of friction, so a bit of time to think. So that's something that maybe you can use with clients. Say, well, let's not act on the information today. How about we have a call in a couple of days and revisit this? And when somebody isn't in that state of fear, they're better able to think and make better choices.
Sorry to jump in. Because when we set up clients, or when we meet clients and we're going through that sort of introductory phase, spend a lot of time talking about time horizon, how long you need to be invested in the market for because of ups and downs, etc. And you explain the volatility that can be, is often realised on an annualised basis. As John said, 10% drawdowns are very normal in equity markets. And, you sit there with a client, you show what potential drawdowns have looked like on a historical basis. And we've got some very good charts that we can run through with clients. And, in that sign-up phase, most clients, it's very clear to me that they understand that there will be volatility. They understand that things will feel ugly at times. And then, of course, when you get to the events, the understanding has gone. And it's, no, but this is different this time. I didn't think there was going to be a war in Iran, or there's going to be something else. But what we try and say back is that we've had worse events than this, that we've got through. Lots of our companies that we invested in have survived 2 world wars. We're not doing that. But what is it about that initial understanding and agreement that clients sort of set themselves up as, but when the real event hits, why, typically very smart people, why can they not almost, go back to the original, or see the wood from the trees as such? And even as fund managers, as calm as we are in front of clients, and we know what we should be doing, we don't make rash decisions. There's still that impulse in us, which is, we should be doing something. We have to be seen to be doing something. So where does that come from? Because that's something I've always been fascinated with. Yeah,
so there's 2 bits of it. One, it's called a loss aversion, and it's a cognitive bias, which means that we feel the pain of losses twice as much as we feel the pleasure of gains. Okay. And so from that point of view, it means that we are going to be looking out and making sure that we don't lose money. It can really play against us, because we might overreact when we see a portfolio going down, but it also means that sometimes we hold on to losses for too long because we hold on to losses for too long because we want to see it go back up. there's that. And then there's the fear, the fact that, as I was saying before, fear stops us from thinking. It prevents us from accessing that rational part of us that was sitting in that initial meeting with you. And that's where maybe even moving beyond having the initial conversation, I would even change the language and call them pre-commitments. Have your client commit to, even if it's just verbally, to the fact that, we are going to be facing this. Markets go through seasons, and sometimes using analogy can be helpful because
seasons is very good, actually. I haven't heard that before, but yeah, I think that would be, that's a very good, useful term, isn't it? Because people can sort of visualize a season as such.
They can visualize it. They know that there's a beginning and an end to it, and then something else comes along, and which is why
winter will pass.
Exactly. and we knew winter was coming, and we knew this was going to be difficult. And maybe talking about, this is the uncomfortable part of staying invested. This is what everybody struggles with. So there's something about normalizing it, rather than dismissing it. It's very different to say, don't worry, look at the numbers, versus saying, yes, we're here. Everybody's scared. We knew this was coming. The winter of investing is the hard bit to stay invested in, but it's what your plan is going to deliver in the long term is the returns that come from staying invested here and not pulling out, not overreacting.
Yeah. And I guess part of our job is to make sure that when we get to winter, that there is sufficient flexibility in people's finances anyway, that they don't need to go and sell anything during nasty periods. They've got other liquidity available if they need it, et cetera, et cetera. I like the friction thing. I think, that idea of, yes, you might want to raise some money. Let's talk about it again tomorrow or the day after. And I think that helps. And then a sort of allied to the friction thing, one of my observations is that the sort of compliancy type people, and that's perhaps being a bit harsh, would say that on a risk spectrum, older people tend to be more risk averse and younger people tend to be more risk taking. And actually my experience of clients is almost the opposite. Clients who've been around for 20, 30 years and they've seen a gazillion cycles, the market has a bit of a wobble. I mean, they don't even know about it because they just don't check. Whereas, our generation and sort of generation slightly older than us will be on the stocks app on their iPhone and they will see the red, and the red itself is, hitting them with the whatever the
It's
phrase
an
I'm
alarm
looking for.
bell.
It's an alarm bell.
Yeah.
And they're the ones who are more concerned and more worried because they're checking their portfolio every day, and it kills me. So that sort of idea of building friction between what they're seeing and the direct consequences on them, I think is definitely a good thing. And I think we need to incorporate that somehow a bit better.
But you touched on something there about making sure that the client has enough room enough flexibility in their portfolio. And that's important because when people are feeling afraid, they tend to catastrophize. So in their minds, they're losing everything. Everything is at risk. But you can remind them that their portfolio has been segmented. There's the bit that's going to meet their short-term needs, and that's safe. That's not at risk. And then there's the longer-term bit, which we're taking risks with, but that doesn't mean, it's all going to be gone. This is part of the process. And making that distinction can already be quite calming because they know that they're going to be okay. They're not going to struggle to pay bills next month just out of this catastrophic thinking.
Yeah. I think actually something we've done internally is the different segments of the portfolio, almost splitting the portfolios as well. So, and I have, worked with one advisor in particular that does this. There are separate portfolios for separate things. So there's sort of the cash plus, which is the gilts, which is the exceptionally secure part of it, which doesn't move, and they know will provide income for the next 5 years. And then you might have something that's more balanced, and then you might have the real growth part of the portfolio. And in reality, that is no different to a medium risk portfolio. It's just they're split, and a client can see that the low risk stuff that they're drawing from hasn't moved, even though the world's falling apart in their mind. And the other parts, let's take the higher risk part. I mean, yes, that part's really fallen, but in their mind, that's sort of the speculative part almost, that it doesn't matter and that will recover in time for them to access part of it when they need it, which will then sort of pull into the income bit. So, or the lower risk bit. So I think again, it's a visualization. If everything's in together and everything's falling, that is panic. But if you can see different segments or different parts that are doing different things, I think that from my experience, that's helped clients quite a lot.
I think there's another thing to bring in. There's another cognitive bias that impacts how we perceive the world today, which is recency bias. So we tend to give a lot more weight to recent events than to things that happened further in the past, which is why sometimes even very intelligent, educated clients might find it difficult to orient themselves or place themselves in the bigger historical picture, because we're wired to pay more attention to what has been happening over the past couple of months. So again, we're fighting not against illiteracy. These are educated investors who know what they're doing, but there are cognitive biases that get in the way, and that we need to help them be aware of so they can manage them differently.
Is there a way that clients can, all of us can, rewire is the wrong word, but is there a way that we can help ourselves in these sort of stress-invoking, very emotional times?
Well, not even in stressful moments. If I said to myself that I'm bad with money, which is effectively not a dissimilar thing, if someone says that they're bad with money, how could we help them, or how can they help themselves either not be bad with money or admit that they're not bad with money, which is perhaps part of the problem? And where does that sort of take us?
Well, it's a big question. So in terms of calming out ourselves, and maybe this answers both questions. There's a lot about accepting feelings, accepting that it's normal to be afraid, to have doubts, to worry. And actually, worry is not always a bad thing. It points to the fact that we care about something enough to be worried about it. But then we can go back to the evidence. We can go back to actually, this is what the portfolio has done in the past. I'm safe, all of that. When it comes to people coming with these big beliefs like I'm bad with money, I always challenge them and try to break it down and say, well, can't be bad with everything when it comes to money. What is it? Saving? Is it spending? Is it investing? What is it? And then slowly they can find where the problem really is. And sometimes it's, I've never invested. I don't know how to do it. Well, okay, does that make you bad with money? Or is that something, it already points you to a solution in a way, Right, you need to learn about investing. You need to find somebody who can help you with it or whatever it is. So I think it's acknowledging that these beliefs can be self-limiting. They're not going to help you move forward in any way. They're just going to keep you stuck where you are. And so you need to challenge yourself to think differently. Okay, I'm not going to sit here in the worry and overreact. I'm not going to sit here with my shame and beat myself up. I'm going to try to think differently and look for a solution, look to understand myself a bit better.
And I think the other thing that you possibly see from a number of people is that if they get to that point where they I'm just terrible with money, I'm just really bad with money, the worst thing they do is just shut down and forget about it and don't do anything at all and carry on with their day-to-day life. And then there'll still be the bits of paper piling up about their pension and about, their cash or whatever it might be, or the bills are piling up and they don't have the ability, well, not the ability, but the wherewithal to say, right, well, and I often sort of think, just disagree with me if you want, just a small action, just taking one step, baby step, if it might be, whether that was to open an ISA account online or move your savings to a higher interest building society account. Just one thing that makes you marginally better will help in terms of getting people moving in the right direction.
Yeah. Avoidance is probably the most common psychological defense against discomfort when it comes to personal finance. And I have seen people in my consulting room who might be extremely successful in their professional life, capable CEOs and CFOs in businesses. And then in their personal finance, it's a whole different story. And that's because there's very complex feelings in the background about how well they have done or haven't done and so on. And things get avoided and they come to me with either pockets of debt or stacks of unopened letters and things that you say, how can this be the same person? But it is easy to avoid things that are difficult, and we really have to push against that.
I was going to come back to the how do we raise children who are good with money, and if we come back to our sort of mythical kind of person who sold a business aged 45, 50, having come from relatively little and has got 2 young children. Luckily, he's met James Hughes, Court Achiever's second best investment manager, and he's guided him on his journey, and he's got him through, and he's got him in a good place, and he's making progress. You know, how can that person, when he asks James, what do I do about my kid? How do I make my kids good with money? How do I put my kids in a stronger position for the rest of their life than I had coming through, and so I didn't have to do? What sort of tips and tricks could you give to us parents out there? It's a entirely selfish question.
Well, so I'd start by saying, acknowledge that you might be giving quite mixed messages to your children, because you might, as we all do, we repeat the same messages we heard growing up. So you might be repeating things that you actually believe, that money doesn't grow on trees and don't take it for granted.
I've definitely told my children that.
But their reality might be different. To them, it might actually be growing on trees if every time they come and ask for the next Lego set, they get it. Anytime they ask for the next gadget, they get it. They don't have a sense of the limits that you had growing up. And so acknowledging that they might be hearing mixed messages is the first part. Yeah. And now that doesn't mean that you need to say no to every request. That wouldn't be appropriate either, because they are growing in a very, they will be seeing you having access to things. Why can't they? So that's not the way to do it. But I think there's something about telling them the story of money, of the family's wealth. Stories stay across generations. They stay in people's minds. And I've certainly heard my adult clients repeating stories of how the wealth was generated in the family and the struggle that the family went through to build the wealth. And that's important for them to bear in mind. And I would also invite people to talk about why they work. Yeah. So a lot of these successful people, they don't go on a beach and retire after they made money. In my experience, they're usually already week 2 after they cash the check, they're already building the next business. Yeah. And the reason is because they enjoy work. They get a sense of purpose from it and motivation. And I would definitely talk about that, the pleasure that comes with work, with building something. And I think that needs to be part of the narrative as well.
It's almost like a competitive instinct that many clients have, particularly those who sold businesses. It becomes a bit of a game, if anything, and they've been successful and they fancy having another crack and want to win another match, right?
Well, and that can be talked about, the fact that, there is the achievement that, your little boy or girl might be getting in sports. You can get that same feeling with work sometimes. And so all of that. But then they need the experience because they don't, children don't just learn from what they're told. They learn from the experiences that they have. And that's where I always encourage parents to give an allowance that children can manage, because that, of course, immediately teaches you that you have a boundary. And so maybe, the parents might address your needs, but when it comes to your wants, you need to make it work with the money you're getting every week. And I wouldn't make that money conditional on anything, on good behavior or anything like that. Okay. That's money you get, and you need to have the freedom to spend it and regret it, or hoard it too much and then envy friends that are actually spending their allowance and getting things for themselves. So those experiences can really stay with you and avoid mistakes that are much bigger later down the line. But also things like, one of my clients was telling me that they give a budget to their child who's in secondary school for an upcoming family bank holiday weekend to go abroad, but they have to plan the whole thing. They have to find the flights, the hotel, the restaurants, and they have to make it work. within a budget. And that really teaches children something about trade-offs. You can't have everything. If you want the nice restaurant, you can't have the nice hotel. You know, if you, all of that thinking that goes. And the other thing is projects that might help them connect with a sense of purpose and achievement that we were talking about earlier. But let's say that, I don't know, they're into, they're into sports, and they might sign up to do a charity run. You know, be with them in that process. Say, right, you've set an objective. And now let's, you know, how are you going to prepare for it? I'm going to set aside some time, and what's your goal, and how much are you going to achieve, and stay with them in the bit in which they're trying. They might be tempted to give up, because the middle bit where they face an obstacle and, I don't know, they get sick, and so they stop training, they have to go back into it. All these experiences help them be reflective around setting a goal, working hard to achieve it, then feeling that sense that.
So it doesn't actually have to be money specific. So I was just thinking with my son, he has a Nintendo Switch, and he's allowed an hour. No, maybe it's half an hour on a Saturday. But if he does certain chores, he gets another half an hour. So he's typically taken over my chores, because I don't like chores. So he has to take the bins out, has to do the dish, you know, all the stuff I don't like doing. So it means I can do less. but so that sort of life experience would be, you know, if you do something that you don't really enjoy doing, or just you know, some sort of chore, whatever it is, then there's reward at the end of it.
Yes, and that can be a helpful way to see that effort brings something, but don't take things for granted. Yeah. So in a way, and I'm not saying that you can't, this might sound like it contradicts the allowance that comes anyway, but actually I think both things can happen at the same time. The allowance needs to be unconditional, so that they know that's coming, they can plan, and when they get a bit older, they can budget and make kind of a bit of a longer term plan with it. So that's important. But then, and I see parents do this quite commonly, you know, to give money for extra things. I don't know, gardening tasks, or
putting your shoes on without being told 4 times.
Well, that could be an expensive thing if it comes with a price tag.
My son's lost 3 pairs of rugby boots this winter. Unfortunately, they all seem to be the same foot. Otherwise, I was going to send him in with odd boots to teach him a lesson, but annoyingly, I can't send him in with 2 right foots.
But maybe there's something there about, you know, if they get immediately replaced at no cost to him, then what incentive does he have to make sure he doesn't lose them?
I totally agree. I hope Mrs. Hughes is listening to this, because that was my argument. So
when you sit down with high net worth individuals and you talk about their money anxiety, money problems, I mean, do you enjoy that part of it? Do you enjoy your job? Do you really get fulfillment and enjoyment from it? Yeah, fulfillment from it.
Yeah, I mean, I love my job. I think enjoyment is a difficult term when it comes to sitting with people's really difficult feelings. I mean, some of my clients have been suicidal at times after big financial losses. So it is a very difficult job, but one that I find incredibly rewarding, because when you see somebody's life change, and sometimes it takes years, it's not a quick fix, but, you know, seeing somebody move from the person they're unhappy with today to a bit closer to the person they want to be, they've always wanted to be, you know, people fulfilling their potential. That's incredibly rewarding to be part of that.
That's good. I mean, do you find the day job rewarding in that sense, Easy? I mean, you've had clients that you've looked after for 10 years, 15 years.
I do. And along the journey, there's been some lovely comments from people just in terms of how much of a difference what we do has made to their lives. And you know, I think when you know, I often say to clients, look, I'm doing the job I'm paid to do when you're not worrying about what the portfolio looks like, because you have complete trust in what we're doing. You know, there's, you know, and again, I think that's where things like monthly standing orders from the portfolio can sort of help separate what the value's doing versus what they're receiving, because then it's they can sort of relax more about it because they know there's certainty coming in over a period, and at the same time every month or 3 months or whatever they decide. But I find the client side and the emotions attached to that, and the word rewarding is totally there. And I do that's the part of it that I probably enjoy the most, to be honest, is the client interactions and the satisfaction from it, from changing someone's lives. I think we're very honoured. We're very lucky to be able to do.
Humble almost.
Yeah, exactly. Humbled is the right word. Yeah.
Anything else you wanted to ask, Izzy, or is there anything you wanted to leave our listeners and viewers with before we wrap it up for a day?
Well, maybe something about financial advisors, because I do see a lot of clients who have gone to see advisors, and I find that the best relationships are the ones in which the clients feel understood. Okay. And not just the ones where they feel they've been given the right solution, but where they've really felt heard. And I think not enough emphasis sometimes is placed on that. And when it is, it makes a big difference. So I'd invite advisors not to be afraid of asking more open questions and really bring a curiosity to that relationship. Really try to understand, what does this person fear? What do they really want? What is the money going to do for them? Because it's not always just about the 10% return or whatever number they have in mind. Right. It's about fulfilling dreams and building the life they want.
I think as an industry, we're bad with throwing technical information and statistics at clients.
Jargon.
Jargon and almost, we almost feel we have to come across in a certain way and prove that, we know the ins and outs of the portfolio and the stocks and investments. And I actually think most clients come to us because they already know that. That's why they're approaching us. Actually, as what you just said is I think often missed. That's so important, is to actually listen to the client. What's in their mind, what looks good, what looks bad, and what do they want to achieve? What objectives do they really have beyond the 10% a year, as you say? All that stuff's important, but it's the feeling and emotions that go with it, isn't it?
And a lot of times, I think there's huge value that maybe advisors underestimate in the fact that you're there as an expert, that people come to not just for the answer, but they come because they want an intelligent person to bounce an idea around with.
Exactly right.
You're giving them an hour in which they can think about their finances, and they're not just thinking on their own, they're thinking with somebody who knows what they're talking about.
Totally.
And so
they can't go and ask this stuff of their mates because it's personal, because it's their money.
And it's personal. And but with you, they can say, well, how about this? They can be a bit playful and creative with it. They kind of, so that's, for the more confident and secure investor, that still delivers great value. And then for people who are avoidant when it comes to money, having that appointment in the diary, even before you've even showed up to it, does a lot for them psychologically. It means that they have to prepare for it. They have to show up for it. So it gives them the reassurance that there's somebody else keeping me accountable here. I can't avoid this. And that has huge value.
Yeah, I agree. I tend to sort of start when I meet a client for a sort of regular-ish review meeting. I got asked yesterday, how do I template my meetings with clients? And I don't really have a sort of set format of we do this, this and this. But I do tend to always ask the client when we first sit down, is there anything on your mind that you wanted to talk about today, before I just launch into, look how well your portfolio's done, 10% this year, aren't we clever? And Donald Trump's done this, but it's all right, don't worry. I do tend to want to see what's on the client's mind before going there, because that does shape how you get there. And I think
that's how I open my sessions. What's on your mind today?
Okay. Well, that's probably quite a good place to leave it, isn't it? Do you think? Probably. Yeah. Great. Thank you, Vicky. Thank you, everyone, for watching. Just as a reminder, Vicky has a book, Money on Your Mind, The Psychology Behind Your Financial Habits, which I'm sure is available from Amazon and other good bookstores. Yeah. Thank you for watching and listening today. Any questions or feedback, then please do let me know. My email address is jonathan.raymond@quiltachieveit.com. Thanks to Vicky again, James, and we'll see you next time. Bye-bye.
Thanks very much. Thanks, Vicky.
Thank you.